quick book recap. All right, let's jump right into it. Today we're taking a deep dive into Tony Robbins' book, Unshakeable. This isn't just, another finance book. It's pitched as a real playbook for finding power and peace of mind with your money, no matter what's going on out there.
That's exactly it. And the big promise, which sounds almost, well, unbelievable at first, is that once you set up your plan, you might only need like an hour or two a year to manage your finances. The goal is freedom from that constant worry.
An hour or two a year. Seriously, that does sound incredible. But I like the core idea, being unshakable. It means having that confidence, sticking to the truth, just feeling calm, even when things seem, crazy.
Yeah, like being the calm eye in the storm. And it feels particularly relevant, doesn't it? I mean, think about 2008 or even weird stuff like negative interest rates popping up in some countries, things that make people feel really uncertain about money.
Totally. Money stuff can feel super intimidating. So our mission today is to kind of demystify it for you, make it feel simple and clear.
Exactly. Break it down.
Okay, so let's get into the meat of it. What does the book say are the biggest things stopping people from being, financially secure? These fierce foes he mentions.
Right. So he boils it down to two main enemies, fear and fees. These two, often working kind of under the radar, can seriously sabotage your wealth building.
Fear. Okay, I get that one. Especially when the news is full of market crashes and dips. How do we deal with that?
Well, he uses this great analogy, the snake and the rope. Imagine you're walking, it's kind of dark, you see a coiled rope, and boom, your brain screams, snake! Fear takes over.
Right, instant panic.
People do the exact same thing with the market. They see a normal dip, a correction, and their fear blows it way out of proportion. They see a snake instead of a rope. And that fear, it stops them from investing or makes them sell at the worst possible time.
So how do you train yourself to see the rope when everything feels like a snake?
You start with the facts. Understand what's normal. Take market corrections, those dips, they're like seasons changing, totally normal. The book points out, on average, they happen almost every single year. Since 1900.
Every year.
Pretty much. So if you're, say, 50 years old, you'll probably live through another 35 of them. And here's a key thing. They're usually fast. Average duration. About 54 days. Less than 2 months.
Okay, less than 2 months. That makes it sound way less terrifying. More like a blip.
Exactly. Now, bear markets, those are the bigger drops, right? They feel scarier.
Yeah, definitely.
But they're also normal. They happen roughly every 3 to 5 years. The average drop is around some 3%, sometimes more, like over 40%. But again, look at the duration. They average about a year.
A year still feels like a long time when your money's going down.
It absolutely feels long in the moment, no doubt. But here's the crucial part people forget. Bear markets always, historically always, turn into bull markets. Think about the huge crash in 2008, 2009. Seemed like the end of the world, right?
Oh, yeah.
But after hitting the bottom in March 2009, the S&P 500 shot up almost 70% in the next 12 months alone.
Wow. Okay, so the real danger isn't the drop itself, but trying to guess the bottom. This market timing thing.
Precisely. Trying to jump in and out at the perfect moments, it's basically a fool's game. Jack Bogle, the Vanguard founder, he put it bluntly. The idea that a bell rings to signal when investors should get into or out of the stock market is simply not credible.
Huh. I like that. And Buffett says something similar, doesn't he?
Yeah, Warren Buffett jokes that stock market forecasters exist only to make fortune tellers look good.
Okay, so timing is out. What's the cost if you try anyway, or if you just sit out and miss the good days?
The cost of missing out is actually staggering. It's huge. Look at this 20-year period, 1996 to 2015. If you were invested the whole time, you got about 8.2% average annual return. But if you missed just the 10 best trading days in those 20 years, your return got slashed almost in half, down to 4.5%.
Just 10 days, over 20 years. That's crazy.
It shows that just being in the market, staying invested consistently, is way more important than trying to be perfect.
Is there a story or example that makes that even clearer?
Yeah, the book has this great little story, Miss Perfect and Mr. Hapless. They both invest the same amount, $2,000 a year for 20 years. Mr. Perfect somehow has magical timing. She invests her $2,000 on the single best day each year when the market is at its lowest point.
Okay, the absolute perfect timing.
Mr. Hapless, on the other hand, has the worst luck imaginable. He invests his $2,000 on the single worst day each year when the market is at its peak.
Oh boy. So Miss Perfect must end up way, way ahead, right?
You'd think it would be a massive difference, but get this. Miss Perfect ends up with about $87,000. Mr. Hapless, he still ends up with over $72,000.
Wait, really? That's not nearly as big a gap as I would have expected.
Exactly. The takeaway is powerful. Even with the worst possible timing. Just consistently being in the market makes a huge difference. Consistency trumps timing.
Yeah, it really drives the point home.
Oh, yeah.
So that's fear. What are the other enemy fees? Are they really that big a deal? Seems like small percentages.
Fees. They're like silent termites just quietly eating away at your savings over time. And most people don't even realize it's happening. There was an AARP study, 71% of people thought they paid no fees in their 401ks.
71%. Wow.
And 92% had no clue how much they were paying. It's shocking.
It's like getting a bill every month but never looking at the amount.
Exactly. And because of compounding, even a seemingly tiny fee difference makes a huge difference long term. Let's say you earn 7% average return over 50 years. Every dollar you invest could grow to maybe $30. But if you're paying 2% in fees each year, your net return is only 5%. That same dollar, it only grows to about $10.
Whoa. So the fees ate up 2/3 of the potential growth.
Pretty much. You took all the risk, put up all the money, and the fees skimmed off a massive chunk of the reward.
That's eye-opening. Can you make that more personal, like with an example?
Sure. Imagine two neighbors, Joe and David. Both start with $100,000, invest the same way, earn 8% a year for 30 years. Joe pays 1% in total fees. David pays 2%. Seemingly small difference. By age 65, Joe has around $865,000. David, he only has about $548,000. That's $317,000 less for David just because of that extra 1% fee.
Wow, over $300,000 difference from just 1%.
And it gets worse. When they retire and start drawing money out, Joe's money lasts him until he's 88. David runs out of money at age 79. That extra 1% literally cost him almost a decade of retirement income.
That is a massive, life-altering difference.
Okay, so how do we avoid these fee traps? What's the deal with active funds versus index funds?
This is a key battleground. Active funds are run by managers who try to beat the market. They buy and sell stocks frequently, trying to pick winners. All that activity costs money, higher management fees, trading costs, and it generates more taxes.
And do they actually beat the market?
That's the kicker.
Yeah.
Most of them don't,
Yeah.
especially after you factor in those higher costs. Study after study shows the vast majority underperform the market over the long run.
So you're paying more for less performance, often. Often, yes. Now compare that to index funds. They don't try to beat the market. They just aim to match a market index, like the S&P 500. They do this by simply buying and holding all the stocks in that index. Very little trading.
Which means
Much, much lower fees, like incredibly low, sometimes 0.05% a year, or even less. And fewer taxes because they aren't trading all the time. Even the biggest investment gurus like Ray Dalio or Warren Buffett recommend low-cost index funds for most everyday investors. Dalio even said beating the market is harder than winning an Olympic gold medal.
okay, index funds seem like the clear winner for most people then. Low fees matches the market. Simple. So we know the enemies, fear and fees. What are the positive rules? The book calls them the core four, right? Learn from top investors.
That's right. These are 4 principles that, despite their different specific strategies, the world's best investors all seem to follow.
Let's break them down. What's principle 1?
Principle 1 is maybe the most famous one, thanks to Warren Buffett. It's simply, don't lose money. His full quote is, rule number 1, never lose money. Rule number 2, never forget rule number 1.
Why is not losing so critical?
Right.
Isn't investing about making money?
It is, but the math of losses is brutal. If you lose 50% of your money, you need to gain 100% just to get back to even. A 100% gain, that can take years, maybe even a decade. So avoiding those big losses is actually more important than chasing huge gains. Smart investors focus heavily on protecting their downside because they know they can't predict the future perfectly.
Okay, protecting your capital is paramount. Got it. Principle 2,
Principle 2, seek asymmetric risk-reward.
asymmetric. Okay, what does that mean in plain English?
It just means looking for investments where the potential upside, the potential gain, is much, much bigger than the potential downside, the risk. You're risking a little to potentially make a lot.
Can you give an example?
Paul Tudor Jones, a legendary hedge fund manager, he aims for trades where he thinks he can make $5 for every $1 he risks, a 5-to-1 ratio.
5 to 1. So even if he's wrong a lot.
Exactly. With a 5-to-1 ratio, he can be wrong 4 out of 5 times and still break even. It builds in a huge margin for error. Or think about Richard Branson starting Virgin Atlantic. Huge risk. Airlines are tough. But he negotiated a deal where he could return the planes if it didn't work out within the first year.
So he limited his potential loss, his downside.
Precisely. Limited downside, massive potential upside if it succeeded. That's asymmetric risk-reward. It's about smart risk-taking, not avoiding risk altogether.
That makes sense. It's about being really intentional with risk. Okay, principle 3.
Principle 3, maximize tax efficiency. This is huge. It's not just about how much you earn, it's about how much you actually get to keep after taxes bite. Billionaires are masters at legally minimizing their tax drag.
Right. The government is a silent partner if you're not careful. So how do average people apply this?
The basics are using tax-advantaged accounts. Max out your 401k, their IRAs. Money in those grows tax-deferred or tax-free, which is a massive advantage over decades. For people with more wealth, there are other strategies. You can give money tax-free each year, currently $18,000 per person in 2024. You can pay tuition or medical bills directly for someone else, and that doesn't count towards the gift limit. Donations to charity can also reduce estate taxes later on.
What about trusts? They always sound so complicated.
They can seem that way, but let's simplify. Think of a revocable living trust. It's basically a container you put your assets in while you're alive. You control it, you can change it anytime. The main benefit, it helped your assets avoid probate court when you pass away, which can be slow, expensive, and public. It just makes things smoother for your family.
Okay, so it simplifies things later. What about other kinds?
For larger estates, you might use an irrevocable trust. This is more like a separate vault. Once assets go in, it's harder to get them back out, but they're generally protected from estate taxes, which can be 40% or more, and potentially from creditors, too. And then there's a special type, an ILIT, or irrevocable life insurance trust. Life insurance payouts usually aren't income taxed, but they can be hit by estate taxes. Putting the policy in an ILIT can help it avoid both.
Wow. Okay, so planning around taxes is definitely key, especially as you build wealth. What's the final core principle, number 4?
Principle 4, diversify your investments wisely. The classic, don't put all your eggs in one basket, but it's more nuanced than people think.
How so? What are the layers of diversification?
There are really 4 key ways to diversify. 1, across asset classes. Don't just own stocks. Own some bonds, maybe real estate, other alternatives. Bonds are basically loans. They behave differently than stocks.
Okay, stocks and bonds. Got it.
2, within asset classes, don't just own one stock like all Apple. Own a basket of different stocks, like through an index fund. 3, across geographies. Don't just invest in your home country. Look globally. The book uses Japan as an example. Their market crashed in '89 and took decades to recover. Investors who only own Japanese stocks were devastated. U.S. investors often make the same mistake, having too much home bias.
That's a really good point. We tend to stick with what we know.
And number 4, diversify across time. Keep investing regularly, month after month, year after year. This is called dollar cost averaging. It smooths out your purchase price and stops you from trying to time the market. You automatically buy more shares when prices are low and fewer when they're high.
And what about rebalancing? How does that fit in?
Rebalancing is crucial for maintaining your diversification. Let's say you decide on a 60% stock, 40% bond mix. If stocks have a great run and suddenly make up 70% of your portfolio, rebalancing means you sell some stocks, selling high, and buy more bonds, buying low, to get back to your 60-40 target. It forces you to systematically buy low and sell high, which is the opposite of what emotion often tells us to do.
So it imposes discipline. Okay, these core 4 principles make a lot of sense, but the book talks a lot about mindset too, right? Mastering your psychology.
Oh, absolutely. It argues that mastering your mind is just as important, maybe even more important, than mastering the money mechanics. Our brains, wired for survival, can seriously mess up our investment decisions.
How does our survival brain interfere?
Well, think about it. Market crash happens. Your ancient lizard brain doesn't see numbers on a screen. It sees a threat, like that saber-toothed tiger. It screams, danger, run, sell everything. Even when logically, rationally, the best move might be to stay calm or even buy more while things are cheap. That primal fear response often leads to terrible decisions.
Yeah, I can see that. What other mental traps does the book warn about?
A big one is overconfidence. We tend to think we're better than average, like that study where 93% of drivers rated themselves above average. In investing, men in particular tend to be more overconfident. They trade more often, thinking they can pick winners or time the market.
And that hurts their returns, like you said earlier.
Exactly. It often leads to lower returns because of trading costs and mistakes. The antidote: humility. Recognize you probably don't have some special edge and stick to a sound, simple plan like using index funds.
Okay, be humble. What else?
Confirmation bias. We love hearing things that confirm what we already believe. We seek out news that agrees with us, friends who think like us. Smart investors actively fight this. They seek out dissenting opinions. They ask, where could I be wrong? What am I missing? Ray Dalio does this constantly.
That takes discipline. to actually look for reasons you might be wrong.
It does. And then there's recency bias. We tend to think whatever just happened will keep happening. If the market's been going up, we assume it'll go up forever. If it just crashed, we think it'll never recover. We overweight recent events in our predictions. Buffett calls it an unshakable habit for many investors.
Man, our brains really seem set up to make investing harder. But okay, let's say we manage our fear, avoid high fees, follow the core four, and work on these biases. We get the money part right. Does that automatically equal happiness? The book seems to suggest. Not necessarily.
That's a huge critical point in the book. Financial freedom is amazing, but it's not the same thing as true fulfillment or happiness. Tony Robbins talks about meeting billionaires who are absolutely miserable. True wealth, he argues, is much broader. It includes your emotional state, your psychological well-being, your spiritual life.
So what do we really want from money then, if not just the money itself?
We want the feelings we think money will bring, right? Freedom, security, joy, the ability to contribute, to help others, excitement, adventure. And the book's powerful message is you don't have to wait until you're rich to feel those things. You can cultivate those states now.
That's a really profound shift in perspective.
Yeah.
It's about the art of fulfillment, as he calls it.
Exactly. Mastering your inner world. If you conquer the external world, get the money, the success, but your inner world is a mess, you'll still be unhappy. He uses the tragic example of Robin Williams, someone who achieved incredible fame, wealth, made millions laugh, but struggled deeply inside. It's that put your own oxygen mask on first idea. You have to nurture your own state to truly thrive and help others.
So how do we do that? How do we choose our state?
It comes down to focus. You can consciously choose to live in a beautiful state, gratitude, joy, curiosity, compassion, or a suffering state, frustration, anger, worry, fear. It's not about what happens to you, it's about where you direct your mental energy. The book offers a really practical tool, the 90-second rule.
Okay, what's that?
If you feel yourself starting to slip into suffering, anger, frustration, whatever, give yourself 90 seconds. Feel it, acknowledge it. But then, after 90 seconds, consciously shift your focus. Ask yourself, what am I grateful for right now? Or what's good about this situation, even if it's small? Because, as the book says, what's wrong is always available, but so is what's right.
90 seconds, that seems manageable, like a mental reset button.
It really is. And another simple practice is gratitude meditation. Just 2 minutes. Focus on things you appreciate, maybe even just the feeling of your heart beating. It's almost impossible to feel angry or fearful when you're genuinely feeling grateful. It instantly changes your physiology and your state. Ultimately, the book argues, the most important decision you make is to commit to living in a beautiful state no matter what, taking 100% responsibility for your inner experience.
That's powerful stuff. Okay, so we're building financial security, mastering our minds. What about protecting it all? The practical side of safeguarding our future and legacy?
Yes, the book covers this crucial area too. First step, find the right financial guide. And the key word here is fiduciary. You want an advisor who is legally obligated to put your interests first, above their own or their firm's.
Not just someone trying to sell me products.
Exactly. Be really careful with dual registrants. These are advisors who can sometimes act as brokers, meaning they can get paid commissions for selling you certain mutual funds or insurance products. That creates a potential conflict of interest.
So how do I know if someone is a true fiduciary? What should I ask?
Ask direct questions. Are you a fiduciary at all times? How are you compensated? Do you receive any commissions or payments for recommending specific products? Also ask, do you offer proprietary funds, meaning funds their own company runs and profits from? The answer should ideally be no. And ask, where will my assets be held? They should be held at a separate, independent custodian, like Schwab, Fidelity, or Pershing, not directly by the advisor's firm. That's a crucial layer of protection for you.
Okay, really important question to ask. Find a true fiduciary. What about legal documents, wills and things?
Absolutely essential. The book uses the Prince example, died without a will, huge mess, millions went to taxes, family fought for years. Don't let that happen. Everyone needs a will. It dictates who gets your assets, your beneficiaries. Crucially, it names a guardian for your minor children. Otherwise, a court decides.
Wow, I didn't realize the court decides guardianship if there's no will.
Yep. The will also names your executor, the person in charge of settling your estate. And it can set up trusts within the will, called testamentary trusts, to manage money for kids until they're older, maybe 25 or 30, instead of them getting it all at 18 or 21.
That seems smart. What about if you're alive but can't make decisions?
That's where a power of attorney comes in. You need one for healthcare decisions and one for financial decisions. It designates someone you trust to make choices for you if you become incapacitated through illness or accident. Without these, your family might have to go to court just to pay your bills or make medical choices. Huge headache.
Okay, will, power of attorney. Got it. What about insurance?
Insurance is key for protection. Life insurance. If people depend on your income, you need it. Term life insurance is usually the best bet for most people. It's simple, cheaper, covers you for a specific term, like 20 or 30 years. Like car insurance, you hope you never use it. Avoid complex, permanent policies with high fees unless you have very specific estate planning needs. Disability insurance. Your ability to earn an income is probably your biggest asset. Disability insurance replaces a portion of your income if you get sick or injured and can't work. Super important.
Makes sense. Protect your income stream. What else?
Long-term care insurance. This covers costs for nursing homes, assisted living, or in-home care later in life. Most people, like 70% over 65, will need some form of long-term care. Very few have insurance for it. It gets really expensive if you wait too long to buy it, so looking into it around age 45, 55 is often wise. And lastly, homeowners insurance. Check your dwelling coverage. Make sure it's enough to rebuild your home, not just its market value. Aim for at least 80% of rebuild cost, ideally 100%. Otherwise, the payout might be less than you expect if you have a major claim.
That's a really practical checklist for protection. Brings peace of mind. Okay, final piece. The book talks about the power of giving, creating a legacy beyond just money.
Yes, it strongly emphasizes this. The truly fulfilled great investors and leaders find immense joy and meaning in giving back. It shifts the focus from accumulation to contribution.
How can we give smarter? Make our giving go further.
There are strategic ways. Donating appreciated stock directly to charity means you typically avoid paying capital gains tax on the growth. That's a big tax benefit. Using a donor-advised fund, DAF, is another great tool. It's like having your own mini charitable foundation. You get the tax deduction when you put money in, but you can decide later which specific charities receive the grants. The book also mentions platforms like CrowdRise, where you can leverage your donation. You might offer a matching grant to incentivize a charity to raise even more money from its own network. Your $100 K might spur them to raise $500 Ks more.
That's cool, multiplying the impact. So it's not about waiting until you are rich to start giving.
Not at all. The book argues that the habit of giving, even small amounts, should start now. If you won't give a dime out of a dollar, you probably won't give a million out of 10 million. Giving actually shifts your mindset from scarcity to abundance. There's more than enough to share. It reinforces feelings of gratitude and connection.
So, wrapping this all up, what's the big takeaway for someone listening? What does becoming unshakable really mean?
It means understanding how markets really work, knowing those dips and corrections are normal. It means shielding yourself from those destructive fees. It means following those simple, timeless core 4 investing principles. And maybe most importantly, it means mastering your own mind, overcoming fear and bias. When you do all that, you build a financial foundation and an inner state that lets you weather any storm with confidence and peace.
It really sounds like the goal isn't just the number in your bank account, but that feeling of genuine well-being, that ability to live in a state of joy and appreciation, regardless of the external circumstances.
Exactly. And the book leaves us with a really provocative final thought. The secret to living is giving. So maybe ask yourself, how could actively choosing to give your time, your skills, your compassion, maybe even a little money, how could starting now actually change your own experience of wealth and happiness, even before you hit all your financial targets?